Thanks everyone joining us today. We had this wonderful webinar that we organized here and invited our guest here to speak with us. So today we were fortunate enough to have David and Tom from BetaShares. It's interesting because, a lot of my clients ask me the question as well, Frank, how you pick ETFs for us, and do you get any insights from these ETF providers? So I said, absolutely. We get all these kind of webinars and this kind of information. But they always ask, oh, is there any opportunities that you would be able to invite them and to give us some insight? And here we are. That's exactly what we're doing here today. I just want to quickly introduce all the guest speakers here today, and I will try to get all to the everyone's interested questions, the topics about the economies and what's happening with the tariff, what's happening with the interest rate cut and all that kind of information. So today we have David Besnes from BetaShares Chief Economist. I know there's a lot that we can read through about David. If anyone look online, probably they can also see the articles that you write previously for the Australian Financial Review. I understand you were a commentator, and also you worked worked as economic roles in Macquarie Bank. So today we're going to have David to walk through what happened in the world, what we're expecting, what's likely that we can anticipate. And also we have Tom from BetaShare as the investment strategist. Tom, congratulations. I understand you recently acquired the CFA qualification.
Yeah, thanks, Frank. No,
that's a lot of effort put in there
exactly
to get there. So I think everyone knows about me. As a financial advisor, we helped a lot of our clients in constructing portfolios and designing investment. I guess today we're going to have the disclaimers here. Whatever we discuss, that's for general information. I understand there are a lot of trends and what's happening in the world, but in terms of how you make your own personal financial decision, it's best to speak to a licensed advisor like myself, that we make sure that we do the right thing for you. But before we get into the details, if there's any disclaimer, David, you wanted to talk about, feel free to let me know and we'll jump back to that page. We just want to quickly talk about what we're gonna go through today. Yes, we're going to talk about the economy, what's happening in the world. We're going to talk about some of the BetaShares investment ideas. And also we want to briefly talk about how we normally construct a portfolio, how we look at some basic design principles, and my role in terms of overall investment for our clients. And obviously we'll leave some time for questions and answers. Okay, without further ado, let me just move into the first one. And David, just let me know if you wanted to move to the next slide. I'll click and get it through.
I might just quickly take this one on behalf of BetaShares, Frank. Hi, everyone online. Thanks for joining us, and thank you, Frank, for having us. It's a really great opportunity to partner with you as one of our clients. For a little bit of context, my name's James. I'm one of the relationship managers here at BetaShares, and I deal with Frank and Jacob there at XIX Wealth. So. Look, a little bit about BetaShares. We're an Australian-based ETF fund manager. We currently have around $51 billion of assets under management, and that's split across around 95 different individual ETFs focusing on different strategies. You've got really simplistic ones like something like the ASX 200, but then we've got some other cool strategies that you'll probably hear more on from Tom later on in the piece that can be sort of segmented to specific thematics or regions and things like that. And the other really cool thing from our end is of the investable or the people that in Australia that do invest, we do have about over 1 million individual investors using our products, whether it be they're by themselves or through an advisor like Frank. Might jump over, thank you. Yeah, cool. Thanks, Frank.
Great, thanks, Frank. Hi, everyone. It's David here. Happy to get into my section on the economic and market outlook. Let's just go to the first slide there, Frank. So the key market issues really, look, you can't go anywhere these days without hearing the name Donald Trump. He is the world's most important man and he wants everybody to know it. The big driver of markets at the moment are the on-again, off-again tariffs, the imposition of taxes on imports into the United States. And the key question is, is he a large tariff in and of itself is a tax on US consumers, a tax on US corporations. It can cause an economic downturn. It can cause inflation to go up. And the big concern has been with whether he will impose big tariffs that could potentially push the economy into recession or not, or will he see sense in that, tariffs aren't really a good idea, and pull back. And at the moment, it looks as if he's pulling back, but I'll get into some of that at the moment. In terms of Australia, the good news here is obviously we've got some risks associated with what Trump does with regard to tariffs, but in Australia, the key driver of the economy and the outlook at the moment is the fact that inflation is coming down. The RBA, in response to that, can bring interest rates back to less restrictive, more normal levels, and help to stimulate some growth in the economy, some growth in corporate earnings, which would be good for the market. And then the last, and Tom will touch on this in a bit more detail, one of the big investment themes within equity markets, in terms of where to invest in markets, has been US large cap tech companies, the Mag 7 as they call, the Googles, the Amazons, the Facebooks, versus the rest. And it's been a feature of the past decade that, the US market and the US large cap tech companies in particular have outperformed most other markets. And the question is, will that continue, or will there be a rotation to other areas? With that, just go to the first slide, the next slide there. So this is just an example of, this is the share of US tariff revenue. So again, for those that don't know, a tariff, it's getting a lot of media play, is a tax on imported goods coming into your country. And this shows you the revenue collected by tariffs in the US as a percent of imports going back, 100 or so years ago. So you can see back in the old days, tariffs were a very big source of revenue. They didn't have income tax, they didn't have corporate tax back in the 18th century, so they relied on taxing goods. Obviously, imports as a share of the economy was still relatively small at that moment. Then we had globalization, liberalization, and tariffs, so you can see, fell away to relatively small part. The average effective tax is relatively small. Trump, and this gives you an order of magnitude. Again, these numbers are jumping around, but at the moment, a 10% tax on everybody and a 30% tariff on China could lead to something like an increase in the tariff rate in the US of around about 15 to 20%, which would take it to the highest tax take since the 1930s. And again, as I said, the issue with tariffs is that it raises prices in the US, it raises the prices of imports, which in turn either businesses have to pass on to consumers or they have to wear in terms of their own profits. So it hits consumer real incomes or it hurts corporate profits. There are some potential long-run advantages if you want to encourage import substitution, but without going into the details, most economists, myself included, would conclude that tariffs are a bad idea. And if anything, these are going to more hurt the US economy than help the US economy, particularly in the short run. So that has been the big issue at the moment for markets. Just go to the next slide.
Sorry, just one sec, Dave. If anyone does have any questions, we forgot to mention at the start, feel free to use the Q&A function and Dave will be able to answer them at the back end of his part.
Yeah, there'll be a little time at the end of my section for questions before we move on to other areas. So look, how markets have responded. You can see this is going back a years of performance. So first and foremost, you look at the Australian market. It's taken quite a tumble from early February to early April. But we've had a V-shaped recovery in equity markets because Donald Trump, at least so far, has backed down from what were initial plans for big tariff increases. So we've had an encouraging rebound in markets. We've also seen bond yields basically, I think in the case of Australia, remain in a choppy sideways range. So not too big an impact on bond yields. You can see the Australian dollar initially did fall on fears of that Trump's tariffs would cause a global recession, which would hurt commodity prices. But since then, the Aussie dollar has bounced back so far. And really the issue at the moment, as I said, Trump is backing down. He's at least postponing big tariff increases, and markets are hopeful that he can strike deals with countries so that he does not need or feel the need to impose big tariff increases, in which case, the outlook would be, a lot better for global markets. Go to the next slide there. And in terms of Australia, this is really a snapshot of what's been going on in the economy. Firstly, if you look at the unemployment rate, despite all the volatility, the rise in inflation we saw through 21-22, it's been quite remarkable that unemployment has stayed quite low, just over 4%. So that's close to what we consider full employment. You know, anyone who seriously wants a job in Australia at the moment can more or less get a job. We think we're close to a fully employed economy. But importantly, it hasn't come at the cost of inflation staying high. So you can see we had, as the economy reopened post-COVID through 21-22, inflation did leap. What I've got there is what's called the trimmed mean measure of inflation. It's an underlying measure of inflation in Australia, stripping out some of the more volatile items. So that got up to almost 7% in late 22, and now it's back down to just under 3%. So again, very good news for our economy. And this has been a feature in around the world, in that prior to the concerns about tariffs from Donald Trump, we've been enjoying what's called a soft landing. We've had inflation coming down globally without economies being pushed into recession. So, you know, were it not for the tariffs, this would be otherwise a very good backdrop for financial markets. And with that, it looks as if, you know, we will get some further interest rate increases, which I think we'll touch on the next couple of slides. So just go to the next. And this is a chart. Look, it's a messy chart, but what I want to highlight here is normally a negative relationship between the unemployment rate, which is on the bottom axis there, and wages growth, which is on the y-axis. So when you get low unemployment, you've got a tight labour market. Workers have good bargaining power, and they usually are able to, you know, use that bargaining power to ask for higher wage increases, which businesses then respond by passing on into higher prices. You get higher inflation. So if you look back in late 2023, we had unemployment just under 4%, about 3.7%, and we had wages growth running at over 4%. So it was a very tight market. We had wages growth high, and the concern was to get wages growth down, to get service sector inflation down, we need to see the unemployment rate push up, which is why the RBA raised interest rates. But as you can see, the line has actually not gone out, it's gone down. So as at February 25, and you can see the wages growth has slowed to just over 3% without any real significant increase in unemployment. So it's been a very nice development in Australia, and the key driver of that decline in inflation in Australia that I made mention of. Just to the next slide there. So what does all this mean, particularly in the case of Australia? Now, US is a trickier situation, but you can see even in the case of the US, despite the concerns about tariffs in the US and the potential, at least short-run inflation impact to the US because of those tariffs, the markets are still pricing in the Federal Reserve cutting rates maybe once, or at least once, possibly twice this year, and then a few more rate cuts through 26, as you can see on that first dotted line. In the case of Australia, I think it's a clearer outlook. We're not raising our tariffs. We're not taxing imports. So there's no inflationary impact from tariffs in Australia. So as inflation continues to come down, and I think it can continue to come down back into the middle of the RBA's 2 to 3% target band, the RBA can continue to cut rates. And the markets have got the cash rate at the moment expected to drop from 3.85% now to around about 3% by early next year. And 3% would be back toward what we consider a normal rate. It's a rate that neither overly restricts economic growth or overly stimulates economic growth. It's sort of like a more of an even keel on the economy. So again, at the moment, inflation has come back into the target. It's at just under 3%, but as it lowers a bit further to around 2.5%, that will allow the RBA to continue to cut rates. I've got them cutting rates again in August and then again in November following the next key quarterly inflation reports. Go to the next slide. What that likely means for house prices, you can see here house prices have flattened off a little bit over the past year because of those high interest rates, biting on affordability. Plus, we did have that rebound in house prices through 23. So high interest rates, a house price rebound led to affordability constraints and house prices broadly flattened off. Now, as the RBA cuts rates, we're probably going to see a bit of a turnaround in the house price outlook. And that's simply because whatever improvement in affordability lower interest rates provide to households, given we've got a supply-constrained housing market, just means households can go out and bid more for a property. And that improvement, short-run improvement in affordability is then offset by a rebound in house prices. So, unfortunately, the overall level of affordability for property becomes as bad as it was before. But it does mean that will come through a rebound in house prices. Going to the next slide. Aussie dollar, you can see I mentioned there that it did bounce back. It did slump and then bounce back. Aussie dollar from a long run perspective is still relatively cheap in the low 60-cent range. And the US dollar from a long run perspective is very expensive. So not sure what the actual catalyst at the moment might be in the short run, but we do know from a longer run perspective, Aussie dollar, I think, is more likely to rise and the US dollar more likely to fall. Simply on a valuation basis. And I think, again, if Donald Trump scales back on the tariff front, there's a renewed optimism about the US outlook and a reduction in risk, in fears around the world. It may actually lead to a softening of the US dollar and a strengthening of the Aussie dollar, because sometimes the US dollar is seen as a safe haven. But if the need for that safe haven is removed, you could allow that US dollar to weaken and the Aussie dollar to strengthen. Just moving right along. Got a couple of slides here. And in terms of the equity market outlook, this shows you all the downturns in the US equity market, i.e. peak to trough. If the market's at a new high and then it pulls back, then it's seen as a drawdown in the market. And the key point here is that the biggest drawdowns in the market, the worst declines in the market, i.e. greater than a 20% decline, that is sustained for up to, a couple of years, 15 to 20 odd months, you usually need a US recession. So everything else you see in the media, yes, it can lead to short-run equity market declines, but if you don't get a US recession associated with it, it's usually a relatively short-run affair, up to, say, 6 to possibly 12 months, but of a decline of 10 to 20%. That's why at the moment, investors are laser focused on whether Trump will cause a recession or not. Because if he doesn't cause a recession, we've probably seen the bottom of the equity market already, that we saw back in early April. If not, unfortunately, it may mean we get a deeper downturn. But my base case, just to lay it on the line, is I think we are seeing Donald Trump buckle on the tariff front. And I think we won't see a return to those big increases in tariffs he was proposing before, which I think will be enough to allow the US economy to keep growing and avoid a recession. Go to the next slide. I think we're almost at my end. And last but not least is just this slide to show that how the US, really since the GFC back in 2009-10, has been outperforming global markets on both you can see relative returns there in the top orange line. And that's been driven by earnings outperformance. So the US market has been delivering stronger earnings than the rest of the world. And associated with that, investors over time have been giving the US market a higher and higher valuation. And if you look at the bottom part of that slide, you can see the valuation of the US market. The PE ratio used to trade close to non-US markets. Now it's trading at quite a wide gap. So that consistent earnings outperformance, investors have rewarded the market by attaching a high valuation of the US. Now, some argue the US is getting expensive as a result. Others would argue that that valuation is justified because of the relative strength of the earnings in the US. Our view is that we may well see a rotation. There is certainly value in other parts of the market, other parts of the global market, some of which Tom may well touch on. Doesn't mean the US may do badly. It just means that there's certainly scope for other parts of the global market to catch up to some of the outperformance, some of the performance of the US has led. So I just really pose that as one of the big within equity, beyond the fact will or not the US go into recession, and as a result, have we already seen the bottom of the equity market decline, is within equity markets, where do you put your money? Is it still the US? Or I would say definitely a good case for the US, but there are value opportunities outside of the US, given this valuation gap that has emerged between the two markets. I'll leave it there. Happy to take any questions that may have emerged.
Dave, I think we've got one question come through from Will, and it's asking about a war in a major country and what we should do or / invest in. But given I know what Tom's going to talk about in his presentation deck, there might be a topical ETF that Tom can maybe answer that question to some effect.
I'll quickly just say, if there is a war, it depends on who's at war. Like obviously, US and China as a war is a bad thing. If it's India and Pakistan, not so much of a, unless it's a nuclear war. So it really depends. But I'll leave it to Tom on that front. It's one of those known unknowns. Wars are always bad. We're just never sure. Russia invaded Ukraine. They're at war, but it hasn't disrupted global markets at the moment. So it really just depends on which country is involved. But I'll leave it with Tom, unless there's another question. Do you see the gold price going up? Just quickly, yes, on gold, I do think gold is continuing to benefit from central banks around the world buying gold to diversify their reserve holdings. So we have still a constructive view on the gold outlook.
Perfect. Thank you so much, David. I guess there's always more questions around where to invest, how to invest in such turbulent times, and there's always things coming up. And I do actually have one question, because this is a perfect slide and telling people where we should thinking about allocating our investment. And I need to talk a little bit more in terms of the non-US, because obviously we can look at Europe, we can look at North America, South America, or emerging countries. What's your take on these different continents, locations?
Look, so if you're talking about non-US, you've really got Europe, Japan, non-Japan Asia, i.e. China, emerging markets. So Europe is very cheap versus the US. The earnings growth, look, I think Tom's going to talk about this a little bit, but one of the hopeful signs for Europe is that they may be boosting growth a bit more through fiscal stimulus. Germany has changed their laws to allow them to spend more on infrastructure, clean energy transition. And the other big development globally is for good or bad, increased defense spending, which will be a stimulus to the European economy. So Europe stands out. Japan's also an interesting one. Just in the short run, Japan has a headwind because the yen may remain a bit strong in the short run. The other one is Asia technology. So if you like technology but think the US market is richly valued, the Chinese Asian tech area is certainly one of interest. It has good earnings growth, and valuations are nowhere near as high as we see in the US market. So there's just some of the opportunities there. But again, I don't want to steal too much of Tom's thunder, because we'll definitely be talking about some of those opportunities, I suspect.
Not a problem. Thank you so much, David.
Okay, I'll leave it with you, and best of luck for the rest of the webinar, and good luck to everybody in their investing journey.
Thanks, David. Thanks for joining us today.
Thanks, David. Okay, great. So with that, we'll talk about some investment ideas, and Dave, touched on all the areas that I'll be touching on as well. I mean, what's been really interesting this year is it's fair to say the past 10 or so years in equity markets, if we look at the broad global indices, growth and returns at the index level has really been driven by the US, and in particular, large US technology companies. We're all probably pretty familiar, and Dave also touched on the Magnificent Seven, those big US technology companies like Microsoft, Apple, Amazon, Alphabet, that have performed so well over a number of years. They're such large companies, but such large earnings growth. And so as investors, a lot of our returns have come from the US and those technology companies. And there's been, to be honest, sporadic areas of interesting investments outside of that. But that's been the dominant theme. But as Dave mentioned, we are at an interesting crux at the moment whereby those large cap technology companies are being challenged, and there are a lot of positive areas or pockets of growth outside of the US. So I'll touch on a few of those today, as well as my thoughts on the Australian market and a few investment ideas within Australia itself. But if we go to the first slide, please, Frank. Dave touched on, the current, I guess, uncertainty within the US market. At the moment, the way I see it is there's short-term and long-term risk in the US market, as well as downside and upside risk. So to break this down, the short-term risk, as Dave mentioned, is just the uncertainty around tariffs. We don't know how tariffs will land, what rate they'll land at, and that's the big short-term risk. The long-term risk is what impact those tariffs have on the economy. So those two things are very uncertain and will play a huge role going forward. And when I talk about upside and downside risks, upside risks are risks of us not being invested and markets performing well. If we think back to April the 2nd, Liberation, there was a big market crash. If you sold out after that market crash, you've missed a lot of upside since then. So those are the upside risks that come with uncertainty. And the downside risks are, of course, the risks of markets selling off and being invested. So the US is quite a challenging market at the moment due to those uncertainties. So if I take a step back and I look at a lot of our clients and a lot of our client portfolios and think about what they're investing in the US, there tends to be a pretty key theme. And that key theme is a lot of our investors have quite high exposure to those big US technology companies. This is a structural reason for this. At the moment, even if you buy the S&P 500 index or broad index fund, you're getting 25% of your money is going to 5 names, the 5 largest names. The top 10 names is close to 50%. So, a lot of your money is going to very few stocks, even at the index level. The same is true for the MSCI World. Even the MSCI World has got a 70% weight towards the US and a very large weight towards US technology within that. Now, am I bearish on US technology? Do I think US technology will do poorly? No, I don't think that's the case. I think they're really great, strong companies with really good earnings growth and good potential, particularly with the rollout of AI and other areas. However, given all the risks that are inherent in the market, do I think it's prudent for investors to think about diversifying their US allocations? Yes, I do. I think that, given the inherent amount of concentration in the indices in a lot of fund managers, us as investors can think about, okay, how can I rediversify my portfolio myself? And if we go to the next slide, please, Frank, a really neat tool and a fund that's been extremely popular both in the US market and the Australian market this year has been the S&P 500 Equal Weight Index. A lot of our clients already have exposure to US tech either through the S&P 500 or the NASDAQ 100 or direct holdings or managers. This ETF just gives greater diversification across the whole US market. So in that chart, you can see the gray lines are showing the percentage weight in the individual stocks. And you can see for the S&P 500, it's got a large overweight in a small number of stocks. And then if we go to that, look at 251 onwards, it's barely holding any of the companies. Whereas the orange line, which is the S&P 500 Equal Weight Index, holds an equal weight in every single company in the S&P 500. So this brings great diversification back to our portfolios. It gives us exposure to companies in financial sectors, in infrastructure sectors that could be set to benefit from some of the US administration's policies around financial deregulation and reshoring of infrastructure. And finally, it brings down the overall valuations of our portfolios. Those tech names trade on quite rich valuations, which Dave touched on in his portfolio. The rest of the US market, not so much so. So these are great tools just to, I guess, help to de-risk portfolios from the US market while still maintaining good exposure to the whole breadth of companies within the market. And we offer both an unhedged and a currency hedge version if clients are worried about currency as well. So that's really how we're viewing the US market at the moment. Frank, if you go to the next slide. Another really interesting area for us is the Chinese market and the Chinese technology companies. If we rewind back to, let's go back to 2018, when the likes of Alibaba, Baidu, Tencent were really growing in prominence, were really, had infrastructure and had technology that was, not too far from what the US giants had at that time. And they're growing quite substantially. And the Chinese government at that time was quite supportive of the Chinese technology companies. But that all came to a head in 2020. In 2020, Jack Ma, the CEO of Alibaba, was about to launch the largest IPO in history with the Ant company IPO. But due to some, I guess, butting of heads with the government quashed that IPO, and for a number of years following that time, really brought out more regulation and investigations into these big technology companies, which hindered their growth for a little while, I think it's fair to say. If you go to the next slide, Frank, so that's the preamble to the Chinese technology sector. But then the issue, the Chinese government is facing at the moment is transitioning into its new era of growth. We know for a long time China had a very strong EM style growth from strong production, strong infrastructure production. But as some of us are probably acutely aware, this led to a pretty large property bubble and a large destruction of wealth within China, which really affected the domestic consumer. And the Chinese government is looking, and they've said this in their 2 sessions meetings in multiple years, they're looking for a source of high quality growth for the future. Now, when you can combine these two narratives, the tech companies were doing really well, how they got restricted by the government, but now the government's looking for this source of high quality growth. And if you go to the next slide there, Frank, we kind of came to almost a Sputnik moment, if you will, earlier on this year. We had this moment in January where a private company in China launched a large language model called DeepSeek that was seen to compete with the big US models. DeepSeek was also unique. It was open source, and so anyone could look at the underlying code and use it. They offered it for free to anyone. So it was great innovation, producing a large language model when companies in China had greater restrictions on the actual infrastructure they could use, as well as some hindrance or some, I guess, or less government help. So this is a great moment just to say the Chinese companies could still innovate, could still compete with the US companies. And it was almost like a large turning point, at least in this part of the cycle, for the Chinese government as well. If you go to the next slide, please, Frank. So I think it was like literally 3 weeks after the launch of that model, we saw a meeting where Xi Jinping invited the CEOs of the large tech companies, Alibaba, Baidu, Tencent, and DeepSeek, for a private entrepreneur meeting to talk about technology in China and talk about how the government and these companies can once again work together. This is a big shift from what we'd seen in the years gone by, and it signals to us that the Chinese government once again will get behind these technology companies, will look to support them and subsidize them to try and A, compete with the US, and B, find a source of long-term high-quality growth. As Dave mentioned, these Chinese technology companies are still trading on very low price-earnings ratios versus their US counterparts. So it's an interesting part of the market for us. Does it mean they'll be successful and they'll compete head-to-head with the US tech giants? That's very hard to say and yet to be seen. But is it a very interesting investment theme once again? I would say yes, it is to us. And I'll come to it in a few slides. We have a fund that invests in this thematic as well. But we can move to the next slide then, Frank. Thanks. So the other really interesting market dynamic going on at the moment is within Europe. For many years, Europe has not been a very exciting investment theme. There's been, a lot of economies with large debts struggling with that. There's been other kind of economies that have had, a very low willingness for government spending. We've had pretty low productivity growth and pretty low innovation. So it hasn't been a very exciting market. However, this year that has changed. And for those investors on the line who are familiar with this quote, Europe's whatever it takes moment, that's a reference to a speech by Mario Draghi, the then president of the ECB, the European Central Bank, back in 2012. And essentially, back in 2012, we were undergoing the European debt crisis, and it appeared for a time that the euro would have to shut down. The euro would cease to exist because countries like Italy, countries like Greece had large debt. They'd lost confidence from their borrowers of that debt, but they couldn't set their own interest rate policy because they're in the eurozone. So it's this huge issue for a number of years. And for a number of years, the ECB, the central bank, just sat on the sidelines and watched until this very, very famous speech when the president came out and said, "We will do whatever it takes to ensure the euro does not collapse." And literally the next day, that instilled enough confidence in global markets. Money started flowing back in. The ECB took action, and that essentially saved the Eurozone. And it's a very famous moment. Now, why is that relevant this year? Well, this quote has once again been used by the European government. If you go to the next slide there, please, Frank. Earlier on this year, in a number of speeches, a number of key moments from the US government with European governments, it became very clear that the US government was fed up spending so much on defense and, I guess, ensuring the security of Europe when the European governments were not playing their part. And so the European governments have come together, and in particularly the head of the Eurozone, and essentially said, we now need to do whatever it takes to shore up our own security and defense. And this is significant for a few reasons. Firstly, if you think about the backdrop I talked about, we're coming from a period of very low willingness for spending in the Eurozone, very low growth. What we've seen since the start of this year is a fundamental shift in that way of thinking. The best example is within Germany. The German government, they had an election a few months ago, and they elected in a new party, a new chancellor. But since 2008, there's been this law in the German law that said the government cannot run a deficit larger than 0.35% of GDP, i.e. the government can't borrow more than 0.35% of GDP. That is so fiscally prudent. If you think about the spending the US is undertaking, even within China, the fiscal stimulus, this is like the complete opposite, right? Well, earlier this year when that chancellor got in, knowing that they needed 2/3 majority to override this bill, he rushed through the outgoing parliament through a coalition they made, a bill that said they can spend as much as they want with no time limit on defense spending, as well as plans for a 500 billion euro spending package on infrastructure. I don't think it can be understated the fundamental shift in thinking we're seeing in the Eurozone here. And Frank, if you go to the next slide, to put this into context, at the moment, the European NATO countries have a spending target of 2%. NATO will meet next month, and they're going to revisit this target, and it's pretty consensus view that spending target will be increased to 3.5%. And if we see the European governments, and a few governments have already committed to this level of spending, 3.5% of GDP, if we were to see that, we're talking about an increase of spending comparable to what the large US technology companies are spending on their AI rollout. So if you think about how exciting and how much return and growth we've seen in AI names over the past few years, we're going to see comparable levels of spending in European defense and infrastructure. And that is why there is the potential for the Eurozone and European countries to see, good, strong economic growth for the first time in a long time. So it's definitely a thematic where we're keeping a close eye on. And Frank, if you go to the next slide, just to give you an idea, and I know, as Frank mentioned at the top, we speak to Frank and the team about these ideas all the time, keep them across all these updates, and he's aware of all these funds. But here's some of the funds that are relevant to what I've spoken to. So that equal weight ETF in the US, we've got an Asia Technology Tigers Fund, which has about 50% Chinese technology, but also holdings in big technology companies outside of China, like Taiwanese Semiconductors and Samsung. And finally, we've got a global defense ETF, so that provides exposure to large defense companies, both in Europe and in the US. And that's one we listed in November last year to turn around 50% in the 6 months since listing. So just to give you a picture of how much growth we've seen within that space.
And I think
that, I might
just to step in regards to the question that was asked by Will, what was going to happen if there's a war? And it looks like the countries are already starting to prepare for these kind of situation that's happening, and definitely with the companies that's in that kind of business, there's going to be profits can be made. And some of the solutions I can see that it's already presented here. It's just a matter of each investor's view how they wanted to position their assets.
Exactly right. I mean, I'd just say I'm personally hoping that this big spending in defense is more of a, security is the best line of defense. If everyone's got such large spending on defense, hopefully nothing does eventuate. But yeah, of course there is that possibility too. But yeah, exactly right. So look, there are certain themes in ETFs for all these possibilities, and defense companies. If we're to see a war break out with major countries, it's very bad for equity markets. But if you look at historical returns of defense companies, obviously quite resilient in that period, because you see huge amounts of government spending going to those areas. So for each investor, every investor have their own views and their own ways they want to invest. But there's usually a different way that Frank can get exposure to that through one of our or one of our other ETF providers, ETFs in the market. And that's great. And so I'll jump ahead now and just talk briefly about the Australian market, given, we're based here in Australia. The Australian market, I guess I see two key issues in the Australian market. Dave talked about the Australian economy being in a pretty good place. For the Australian equity market, I see two key struggles. The first is around earnings. Just like the US market, the Australian market is also fairly concentrated at the index level. We're talking about the ASX 200. The companies with the biggest weights tend to be these big banks and big resource companies. And our big banks are big, mature banks, but they've got fairly low earnings growth, and the resource companies have been under pressure for a while due to lowering commodity prices. And so what I've got on screen here with these three orange lines, is the market's expectations for future earnings in the ASX 200. So for instance, that top light orange line is, okay, what does the market expect the ASX 200's earnings to be at the end of 2026? And a key trend you can see here is those earnings tend to get revised downwards. We tend to see at the start of the period, analysts expect around 8-9% earnings growth. And by the time we get to the actual end of the period, we got to the end of 2024, we saw about 3-4%, which is pretty low growth. The Magnificent Seven, we're talking about 20% growth. So that's a concern of mine. But if we look at the next slide, if we think within the Australian market, there are pockets of companies that have very strong earnings growth. So that last chart was the ASX 200, which is skewed towards those big technology companies. What I have here is the earnings growth of a high quality index in the Australian market. So this quality index, it seeks out companies with high earnings growth, low debt to equity, good earnings stability. So it seeks out companies that have strong earnings growth and stability. And you can see here the opposite's going on. You're seeing strong earnings revisions to the upward, supporting price performance. And so investors are able to seek out companies like this through ETFs. If you go to the next slide there, Frank, a few examples in our suite, you can see here, this is just returns in 2024, but that light orange line was our Australian technology ETF, which invests in a basket of technology companies in Australia. That one doesn't necessarily seek out the high quality companies, but a lot of the high earnings growth companies tend to be in that index. Look, it is a lot more volatile, more high risk, higher growth potential, higher loss potential. But it's an exciting part of the Australian market. Again, thinking about that ASX 200 level, where we saw those earnings downgrades, in the ASX 200, the technology sector makes up 2% of that index. So these companies don't have an impact on the earnings growth of that broader index, but you can access them through an ETF like ATEC. The darker orange line, that is our Australian Quality Leaders ETF, and that's the ETF that we saw the earnings of in the previous graph, those strong earnings growth revisions. That one's more of a core ETF, considered the core of someone's portfolio potentially. It's because of the way we've constructed it. It holds those high quality companies alongside the large companies in Australia, just to provide some balance, not make it too skewed one way or other. But with the large companies, the big banks and resource companies, we also reweight them by their quality score. So it's a little in the weeds. If it does interest you, look, again, ourselves and Frank have all the info, so we can always provide more info. If we go to the next slide, we can get a bit of a flavour of what it looks like under the hood. This Australian Quality ETF, you can see it's got 40 holdings. Some of the largest overweights there on screen. So, Hub24 is a financial platform. Breville Group has the appliances. These are the type of companies in Australia that have really strong earnings growth, really exciting companies that are a bit underrepresented in the broader Australian market. And you can see on the right-hand side there, just that, those stronger quality metrics from this portfolio. This has been one of our most popular funds over the past few years in Australia as well. And then just finally, I've got a few more slides, just on one more ETF. So something else that's very important to us as Australian investors are dividends. We love the Australian market for the great dividends they pay, the great frank dividends. these are coming under pressure a little bit as well. We've seen, at the moment, the expectations for the next 12 months is the lowest dividend yield we've seen since pre-GFC, if we ignore the 2000 the COVID aberration. So very low levels of forward earnings expected, again, from the broader index level. Why is that? Resource companies cutting their dividends, the big banks keeping up most of their dividends, but their price is appreciating higher than their dividend payout, so the yield goes down. That's a bit complicated, all good, don't worry. But if we go to the next slide, again, what the great thing about ETFs and the great thing about what we provide here at BetaShares and what we talk to advisors about is there's really great solutions for all types of investors. So this is a really great income solution here. There's a lot going on screen. Just to walk you through it, though, this is what's called a covered call strategy. Essentially, we hold a basket of Australian companies. So we get the dividends from those companies. And then we also do something that's known as selling call options. We sell these call options and we get income from doing that. So we get the extra income. But what does selling these call options mean? It means we give up some potential upside in the stock price. To very quickly run through that chart on screen, the orange line, the dark orange line is if that's going down, this fund YMAX is underperforming the market. If that's going up, it's outperforming the market. The black line is the returns of the market. So very simply, that first red bar, you can see the black line's increasing really strongly. So our fund is actually underperforming the market because we've sold those call options, we've got the income from it, but we're losing some of the upside, right? In the green section, it's the opposite. The market's going down, the black line's going down, our line's going up very strongly. We've sold the call options, we've got the income, and nothing's happened. We haven't forgone any upside because there is no upside. But finally, and most pertinently, is the blue section. In the blue section, the black line's just grinding higher slowly, very volatile, and our fund is outperforming that period. Why is that? We're getting the underlying dividends from the underlying market. We get the extra income from selling the call options, and they're not being called away. And the more volatility, the more income we get. So this is a really good market environment for a strategy like YMAX. Now, why is that quite pertinent? Well, it's somewhat likely we could see a slowly grinding higher market in Australia. So it could be a really good environment for this. If you go to the next slide there, just my final slide, Frank, here's the kicker. Obviously, being a fund talking about income, you can see just how much more income it's generating than the broader market. On the left-hand side there, which is the fund I was talking about, you're looking at about 7.5% in cash yield and 1.6% in franking yield versus the broader market at 3.7% and 1.2%. Look, those funds can be a bit more complicated. That's why it's so important to work with someone like Frank. And, we've done webinars in the past explaining, and we've got really great brochures that Frank can provide to you if something like that is of interest or if income something you want to learn more about. But with that, I'll just say, as Frank did at the start of the presentation, just a general disclaimer, all that information was general in nature. Remember, there's a lot of risks in all these investments. And I think look, all of this really is summed up in working with someone like Frank and the team there is so important in understanding what's going on in markets, knowing what products there are to invest in, and then understanding the risks in those products. So with that, I think I'll hand to you, Frank, for the final section around that. I think you're on mute there.
Yeah. I guess, since I got you here, Tom, I guess this is just a very unique opportunity that we could have you here and with that kind of level of knowledge to share with us. I don't know if anyone has any kind of questions that you wanted to put on the chat. Feel free to drop in the Q&A or pop in the chat. But I do actually have a few more questions for you, Tom.
Yeah.
Because I can always talk about my part in another webinar, but this opportunity is really unique to us. So it feels like now we have different ETF for different market, for different situation, right? So there's different strategies. So for someone who's just getting to know what ETF stands for, right? So how that really works. What could it be like a pathway, like maybe a guide for them to learn a little bit more and to understand a little bit more and perhaps, with time, then they have a little bit of experience. The reason why I say that is because we talk to a lot of young people and they say, look, well, I can just open up a ComSec account or a trading account and buy ETF. Why would I need your help to, build a portfolio for us? And we're happy to learn. But what we as an advisor really wanted to advocate is, yes, we wanted to provide the materials and for them to understand how to get started. And if they find it's way too complex, and if they find out it's not just the experience and knowledge, they actually need professional help, we can definitely step in to help them. Can they find other information like online or on your website?
Yeah, definitely. Probably a few points in that question. Firstly, yeah, there is great education tools, and our website's a great place to go. We've actually got a whole series of education videos, nice, short, digestible videos on everywhere from the very basics of ETFs all the way through to different ETFs you can access, through to things like asset allocation and how to actually build a portfolio. I've just lost my train of thought for a second. Well, the second part I was going to say is to your point, a lot of younger investors will tend to say it, right? They say, well, I can go on ComSec, I know what an ETF is, I can just jump on there. But things like asset allocation, things like diversification is something that a lot of uneducated investors won't really know about. Like we'll see investors who speak like that, but then they'll be holding the NASDAQ 100, the S&P 500, the MSCI World, and a global AI fund and a global, technology fund. And if you look under the hood of each of those ETFs, they're probably holding like the same 5 companies in such a high way across each of those ETFs. And so it's things like that. It's things like understanding the underlying investment. It's things like understanding the benefits of asset allocation, particularly once an investor's grown their wealth a little bit. Understanding the benefits of diversification, of using Australian equities and global equities together. So look, yeah, on our website, there are great resources, and there's literally an education center with those education series videos. So I'd highly recommend anyone look at those. But then, yeah, once you're along your wealth journey and you've accumulated a bit of wealth, we definitely advocate for advice and for seeking advice just to understand some of the more nuances, I guess.
Yeah, absolutely. I mean, because I worked with you guys for many years back when we didn't at the time we didn't have so many different options, but now it appears like every year we have new options that we can consider, and that is really exciting. You're absolutely right, because when we sitting down with our clients and we always look at, yes, you can go buy everything online with your ComSec trading or with any other trading platform to buy exactly what we can build for you. But what exactly we're looking, what kind of extra value that we can add in terms of your investment. I think a couple of things that we put in here is we really look at with each client what kind of life stage that you're going through, because we can see we have really young people that just starting off to learn how to invest, and we have wealth accumulators that wanting to maybe have more income than growth, or people who are already retiring, they want to have the security to preserve their capital instead of betting all the money into NASDAQ to have that kind of excitement. We have people going through different life stages, and I think what I have been focusing on quite heavily is managing the expectations, because they can always put in a code and buy something, but how they manage the expectation when there's a market going up or down. Are they going to just sell it, or are they going to follow a certain investment strategy? So that comes down to where we look at the goals and how much you wanted to accumulate either inside your superannuation, or you have your personal saving goals that you wanted to achieve, maybe saved up to enough to buy a property, things like that. Because without a particular goal, it is very hard to align with the market volatility with how we're going to get there. Oftentimes when we're sitting down with our clients, we often ask the question of, say, do you really want to have a really high growth, but not so much of an income that you need to pay tax on during this time? or you want to just to make sure that you don't see much of a volatility, just the steady growth. So these are where I talked about managing expectations, because if we don't tailor them and put it into the right proportion, then it's very hard to know what could happen, and when that happens, what can you do about it? And also with tax, I think that's an extra value that we added in here, especially when we look at incomes, franking credits, and even people like as non-tax residents, how we can invest into making sure that they don't pay any tax, or they don't pay too much tax. So these are the things that we add on top of just simply choosing which ETF. Interestingly, with our tailored ETF, we have about 14, 15 different ETFs that we put in there to make sure we have some of the core principles in this portfolio. So we need to consider location. Should we invest into the US, European countries, Asian countries, and Australia? How much that we should put in there? We should have a guideline in terms of asset allocation, a different type of location. And also we should manage, how we can quickly turn them into cash. Some of these are aimed actually for long term. If we just to sell them and without really fully capitalizing the growth, then I don't think that's going to be a sustainable strategy for us. We also look at how we can rebalance when, we have super investment, when money comes in, is it the right timing that we put in a bit more into this sector or the other sector, or just rebalance across the board? So I think when we design portfolios, it's a very tailored approach. It's not simply just, okay, we're going to buy NASDAQ here, or we're going to just, putting some S&P 500 here, or are we just going to putting some, artificial intelligence robotics, the one that you guys offered there, but more or less of how we really control the investment time horizon and our risk tolerance. Just in the conscious of time, I think just to sum it up as how we really create long-term value, I think today's 60 minutes, today's session speaks a lot. I think this is the first time we invited a chief economist and also you, Tom, investment strategist, to come in and discuss this in detail with us. Because in the past, we just purely talking about how we manage our goals and these kind of stuff. But today we're actually have more realistic what's happening in the world and things that we can relate to. So when we look at that, we obviously is considering what kind of ride or the wave that we're riding through the market. Is the interest going down or going up? And are we anticipating economic growth, or economic entering into a recession, things like that. So if we can have a bigger picture of what we're going through, it is much easier for us to look at our strategies and in our particular goals and how we can implement these strategies. So I think adding all these small pieces together and adding our clients at the center where we're looking at the goals, we're able to help each individual client to achieve their goals in a much more efficient way, smarter way. I don't want to go into too much of these details in terms of how we build portfolio, because everyone's different. But really, I want to just to stress that today we're talking about different ETFs and how these ETFs can play in different scenarios. And also we talk about how me as an advisor would be able to help clients to tailor their investment solutions. And hopefully, if there's any questions that feel free to pop into the chat, or can give it to Tom or myself to answer. Give it a few more minutes. I was supposed to talk about this, Tom. Common pitfalls.
Yeah, I mean,
yeah, these are interesting stuff. That the reason why I don't want to spend too much time on this is because over that many years, I've seen people, very savvy people, investing into ETFs and coming to us and say, "Look, Frank, I'm just not happy with the portfolio." I said, "Look, what's the problem?" And they say, "Oh, I just don't know. Should I keep it or should I sell it?" So that's very clear that there's no clear goal. Well, what exactly you want to do with this and how you wanted to hold on to it, or how long you want to hold on to it. I mean, some of these are very important questions, but people just get too excited to say, okay, we gotta a defense ETF now. We should give it a try. We have seen people doing that. But over time, once they try different ETFs and they see the ups and downs and they didn't quite understand what's happening behind the scenes, and that's where they get frustrated. And they probably just scale back to having an ASX 200 or NASDAQ 100. And that's probably, the easiest way, just to park the money there. But I guess there's a whole lot more that we can do with this. Okay. Well, I don't see any questions that post here. I presume, this would have been a recording that online. So anyone's, listening to this recording, and thanks for the time with us. And I don't know if there's anything that you wanted to add to this presentation, Tom.
No, it's all great. Honestly, I think we've covered. We've obviously covered a lot from the economics, the investment ideas, to the benefits of using advice. I think, as you said, if putting that all together, we spend a lot of our time looking into these investment ideas. Dave thinks about the economy, and Frank thinks about the individual investors and how, what's most appropriate. It probably just gives a sense of how much goes into it all and why it can be, it can be beneficial speaking to someone. But hopefully the investors took a lot away from today. And, as we mentioned, we speak with Frank in the business a lot. So, any questions you have for us, please pass them through Frank, and we'll get back to you.
Not a problem. Well, thank you so much for your time, for Tom and James. Thanks again. And if in the future we have the opportunity to invite you guys to give us another update, we'll surely get you guys on our channel.
Oh, great. Look forward to it.
Thanks, Frank.
Okay.
See you later. See you guys. Thanks
Bye.
for having us.